Hello and welcome. If you're aiming to enhance your financial strategy, you're in the right place. Gary Heldt from Small Business Advisors has delivered a powerful session titled Breaking the Tax Code, a game plan to maximize 2024 business deductions for the Greater Cropland Chamber of Commerce exclusive business information group meeting. Renowned for their exceptional service in Cropland, Maryland, Gary and his team focus on professionalism, responsiveness, and delivering quality advice. This session is packed with essential strategies for effective tax planning and making informed financial decisions for the next year. We're thrilled to bring this valuable presentation to you. It's an incredible chance to benefit from Gary's extensive expertise in financial planning and tax deductions. Thank you for joining us, and we're sure you'll find immense value in Gary's insights.
What I wanted to talk about today was, we're going into a new calendar year, new tax year, and trying to get your business ready for tax for performance throughout 2024. We have a lot of tax law changes that are going to expire at the end of 2025. And people think, oh, well, then I have a couple of years to wait for that. Well, no, you really need to start planning now from the standpoint of you need to shift some income, purchasing assets, and things like that. So I'm going to go through some different strategies that really are good to look at now. And then I would say would also be good to look at, especially at the end of the year, to make sure that you aren't missing things. Again, throw the disclaimer out here. Tax laws and regulations, they do vary from jurisdiction to jurisdiction, state to state. So I'm going to talk more in general about a lot of these different tax strategies and tips and things like that. So please, I'm going to say, don't take what I'm saying as gospel, because it may or may not apply to you in your particular situation. So you want to make sure that you do talk to someone who has knowledge of your tax situation. So first thing is, reviewing and updating your records. And it's like, that kind of sounds like common sense, but really I have found that many times people wait, and it's, until the bank says, hey, I need a financial statement, or you need to prepare your taxes, or maybe you're going for a loan or anything else to update things. And really, you need to update things on a weekly, monthly basis to be able to make sure, how are you able to measure where you're going if you're not looking at it on a regular basis. Something that people, when we talk about updating and reviewing records, that people don't think about is their budget. And I know everybody hates that word budget. But the issue is that if you don't have a budget, how do you know where you're going? For the chamber, we put together a budget for my business. And even though I've been in business now for 25 years, I put together a budget every year because I need to know what my forecasts are. So if I lose a particular client because they sell their business or whatever, that's income that's going away from me. So how can I shift to either go out and pick up that business, because it may be that it's a larger client and I may need to pick up 2 or 3 smaller clients, or looking at, if I want to bring in a larger client, being able to bring in the personnel to be able to handle that work. So if I don't have a budget and know what my incremental costs are by adding someone new, then how am I going to be able to succeed? So that's why it's important to be able to update your records and keep them current. Don't wait until the end of the year or until somebody says, hey, I need to have a profit and loss and a balance sheet. If you currently have a CPA that you're working with, or someone who's doing your bookkeeping, and they're not giving this to you at a minimum on a monthly basis, it's time that you look for somebody else, because with the market that we are in right now, it's imperative that you have this. Another thing, lots of times now the banks are asking when they're doing, any type of, if you're doing any type of ACHs, if you have a line of credit, they're doing more of I'm going to say a background check, making sure compliance wise that you're staying current with things. Because again, it's a much bigger risk now for everybody. So, you need to really make sure that you're keeping everything current. Looking at your business structure. Many times when people first go into business, that they talk to their next door neighbor, they talk to somebody that has started a business, and they've gone, oh, go set up as a sole proprietor, or go set up your LLC. Well, the issue is you go set up that LLC and that's all you do. Well, for tax purposes, that means you're a sole proprietor. And a lot of people don't know that, which means that whatever your profit is that you have, you're paying self-employment tax on 100% of that profit, plus you're paying federal and state tax. So that may not be the right thing for you. I kind of have a rule of thumb that, it's good to be that sole proprietor LLC up until you're profiting about 50,000. Once you make above 50,000, it makes more tax sense to convert either to an S Corp or a C Corp, depending on your situation. And I say that because when you switch to an S or a C Corp, you as the owner of the business, you have to take a salary. As a sole member LLC, sole proprietor for tax purposes, you are not allowed to take a paycheck from your business. So when you take that paycheck, there's additional costs because you're going to have to pay to have the corporate tax return done. You're going to have to pay to have payroll done and payroll taxes. So when I run the numbers, that $50,000 number seems to be the right number to make it beneficial from a tax standpoint to make that shift. So it's important to make sure, for your business, is this the best thing? If you own a rental property or you want to get into the rental market, the LLC is the right way to go from a legal protection side. From a tax standpoint, that LLC, unless you're doing this with someone else, which would make it a partnership, you're reporting on your Schedule E just like you would if you owned it by yourself in your name. But again, you want to have that legal protection, and that's why we're going the route of the LLC. Okay. Later on, if we have time, I'll talk about the Corporate Transparency Act a little bit and the beneficial ownership filings that need to be done now with Vincent.
Oh, here's a question.
Yes.
So with the rental property in the LLC, you suggest if you already have one, moving it to LLC, or is that possible?
That's going to be expensive.
Okay.
And the reason why is because if you have a loan on it, you're going to have to get the mortgage company to be willing to change it. And lots of times that's cost prohibitive to people.
Right.
And what I've seen people make mistakes is that they have that property in their name and they set up the LLC and they say, oh, my property's an LLC. And it's like, well, no, it's not, but you're running everything through. There are ways to do that where you can have an attorney draw up an agreement that your LLC is collecting everything, doing everything. It still gets reported to you. But from a legal standpoint, there's a contract between you personally and the LLC that you set up. So that's a way to kind of get around it. The property is not owned by the LLC, but you are managing and operating it through your LLC.
Okay.
All right. Maximizing deductions. Again, this is something that we run across all the time with people. Oh, what can I claim? What can I not claim? One of the biggest things is home office expenses. Everybody always says, oh, that's a red flag. Think about it. They've now come up with a standard deduction for home office. Do you think that they would come up with a standard deduction if they were really worried about auditing it? They're actually trying to simplify it. And it's actually called the simplified method. And if you're a sole proprietor, it's a matter of just square footage. Square footage of your house, square footage of your office. Now, it does have to be exclusive use. So taking and having your guest room that seconds as your home office, technically you're not allowed to write that off. Or if you say, oh, it's the corner of the basement, or it's the corner of my dining room table, that's not considered an office because it's not exclusively used for those purposes. You can, if you have an S corporation or a C corporation, you could pay yourself rent to be able to do this. If you have an expense reimbursement plan through your company can reimburse you for those household expenses. So there's multiple ways that you can make this work. But again, it goes back to doing some planning and documenting. You know, so many times people come in after the fact, they don't have any of this documentation, they get audited and all of it's, you know, disallowed. And then they're saying, well, my CPA told me I can do this. It's like, yes, you can, but you have to have the proper documentation to be able to do it. Looking at, you know, a couple of years ago, you know, they first eliminated meals and entertainment. Then they came back and said, okay, meals are allowed, but entertainment's not. So the tickets to the Ravens game this weekend, your business can't write it off. If you take a client and you have a meal beforehand and you guys discuss business and then you go to the game, you're allowed to write that meal off, but just not the cost of the tickets. Same thing if you go to the theater or anything else like that.
So if you take the client to the game, you're not allowed to take that.
Correct. So that back in 2018, that's when that changed. Now, as of right now, that expires at the end of 2025. So we'll see what happens with that. You know, they really, Congress has really tried to push that because again, way back years ago, you used to be able to deduct, you know, country club dues, the cost of your membership to the theater and all this stuff. You used to be able to write that off. And then they changed it to where it's like, okay, you can't write off your dues, but if you take someone out and you pay for them to play, you can write off that. And then now it's just strictly meals. Okay.
Yeah, so I guess the question, go back for a second about the yourself running for home office. Is that like on a monthly basis, or is that, I read somewhere about you can rent out your house to your business for like 2 weeks, like the Augusta rule?
Yeah, so that's called the Augusta rule.
Okay.
Or some people call it the master's rule.
Right.
So what happens is that people would go to these tournaments and they would rent out their homes to the golfers or whoever. And if it's less than 14 days, then you are able to not pay tax on that income that you receive. Okay. Your business renting from you under that circumstance, it can be done, but you have to be careful because you have to make sure, is it the right amount of rent? So how much does it cost for me to, you know, go to Crown Plaza and rent you know, the ballroom? And it's not so much the rent of the ballroom that costs you the large amount of money. It's the catering and the AV equipment and all that stuff that costs so much. Right. So you have to be careful with that. But yes, there is the Augusta rule. That again, it's up to 14 days. You go 15 days, and it doesn't have to be, you know, consecutive days. It's 14 days in the calendar year.
Okay. So was that what you meant? Or was that something different?
No, that's totally different thing. So, I mean, literally, if your office is in your home, you can come up with a market rate for rent, and you can have a lease between you and your business that your business is paying you personally rent. You're reporting that on a Schedule E, and all of your household expenses and stuff will go against that.
So you would suggest doing that versus just
everybody's situation is a little bit different because there also is the accountable plan that your business can have. And basically that accountable plan talks about reimbursement of expenses. So you could go that route, and if it's reimbursing you, then at that point you're not reporting any income anywhere because it's a reimbursement. Okay. But again, everybody's situation is a little bit different. That's why I'm just there's multiple ways to skin this cat is basically
Okay.
what it is, but it's, again, it just kind of comes back down to the planning side.
Okay.
So paying family members, you know, last time you go back to the rental property, you know, scenario. You have a couple rental properties and you have your son or daughter go mow the grass and do stuff around those properties. Well, why not pay them? You know, at that point, they're legitimately doing work for you. You pay them, they have earned income at their tax rate, which is 0, compared to yours, which is whatever, 24, 32%, you know, federal, and another, you know, 7% for the state of Maryland. So at that point, you're moving in, you're shifting income from your income tax bracket, which is much higher, to theirs, which is typically going to be 0. Then with that money, because they now have earned income, they're allowed to put money in a Roth. So think about it, 15-year-old, 16-year-old starts putting money into a Roth. You know, they can put up to $6,500 in. Starting that now, and then when they get to the age of 60, there's going to be $800 to $1 million in there.
Now,
If they do it for a couple of
is
years.
there a minimum age your children have to be? I'm sure there is, but I don't know. And there's like minimum max you can pay them. I think it's like 16,000.
No. So you have to, you know, you have to be careful with that, because it has to be something that is, the rate has to equate to what they're doing.
Okay.
Like, I can't have my son come in and shred paper and pay him $30 an hour. That just doesn't work. Now, minimum wage in the state of Maryland is $15 an hour. There are some caveats to that. But with that, you know, they do need to have a bona fide job. You do need to have timesheets and stuff like that. But the other thing could be, you know, if your parents, if they are in a lower income tax bracket than you and you help them out, you could hire your parents to do work for you, whatever it is. And, you know, many times we have people that are in the trades that parents are older and they hire dad to go run and pick up different stuff from Home Depot or Lowe's or whatever and deliver it to the job site. So helping out the owner, because he's not, you know, paying somebody full-time and benefits and everything else. It's also helping dad out because he wants to get out of the house type thing. And it's, again, shifting income from your tax bracket, which is higher, to someone who's at a lower tax bracket. But again, you do have to have, you know, a bona fide job, you know, for them.
And is the age like, is it 14 or 16? Or
Yeah, there's actually case law as young as 8.
Oh, wow. Okay.
You know, so, but again, it depends on what you're going to have them, you know, have them doing. I mean, you know, both of my kids work in my business, various different things, and I pay them. They keep a timesheet and I pay them accordingly.
Okay.
And then I am putting their money into a Roth for them, you know, so. Asset purchases and depreciation. So a lot of people, when they purchase assets in a business, lots of times they try to end up, you know, hiding this in office supplies or cost of goods sold or whatever. The assets that you purchase, you really do want to treat those as assets, because for a number of reasons. One, it shows up on your balance sheet, and it's going to show you having a stronger financial position. 2, it will help you, and we'll talk about this in a little bit, with your qualified business income deduction. And then, you know, 3, and this is the thing that a lot of people don't want to do it because they're like, oh, well, in the state of Maryland, now we got to pay personal property tax on it. It's like, really, I mean, if you really look at that rate, it's so low that it doesn't make sense to worry about that, because of the other benefits that you get from it. So it is important to make sure that, you know, you do capture the assets that you purchase, and you do depreciate them correctly. And there's a number of ways that you can depreciate them. So section 179 is the one that everybody talks about because it's expensing 100% of that asset in the year that you purchase. The cap on that for 2024 is $1,220,000. So your first $1,220,000 worth of assets, qualifying assets, you get to write off 100%. So, you know, I think most of us aren't going to be at that level in 1 year. You know, so it just shows you how I'm still expensing it, but I'm still classifying it as an asset. So you want to make sure you take advantage of that. There's also bonus depreciation that you're able to take right now. You got to be careful with the bonus depreciation is going down, but you have to be careful with that because each year you have to make an election for that. So most CPAs are well versed on this and they're taking advantage of it. But again, it's just another way. Lots of times with Section 179, the IRS follows it, but the states don't always follow it. So where bonus depreciation, you know, the states, most states aren't doing it at all, but they will allow you to do some of the Section 179, but it's limited. So you just have to be careful with that because of you'll be taxed on the state level on it, but not on the federal level. Qualified business income deduction. So if you have a pass-through entity, depending on your income level, you were able to take a deduction of 20% of your business income as a deduction on your personal tax return. If you're above the income limitations for that, then it falls into, they look at the W-2 wages that you paid, including your own, but then they also look at the dollar amount of property that your business owns. So that's one of the reasons why I said earlier, to make sure you record those assets. So then that way it will help you with this qualified business income deduction if your income is too high. It's not just your business income. If you're married and your spouse has a W-2, their W-2, it's all based off of taxable income. So it's all of your income, including dividends and everything else, that makes up that taxable income number. The deduction is only based on your pass-through entity income. So you got to make sure it's a complicated formula, but all of the pieces kind of fit into place. But that's why I say a lot of times people are expensing through office supplies or cost of goods sold or whatever these assets that they're purchasing, and then the problem is that it hurts them with this later on. So be careful with that too. Retirement contributions. I think as a business owner, this is the #1 missed deduction that people don't do, and it's because I have to put money away from my employees. You know, my opinion is a 401k is great for your employees. Cash balance plan is awesome for the owner. And the reason being is that there's testing that needs to be done with the cash balance plan. And as a owner, you're typically able to put more money away for yourself in a cash balance plan that you're not able to do or that you don't have to do for your employees. But again, you still have to have that 401k plan. You still have to make some profit sharing contributions and stuff for your employees. But you know, that's where an actuarial firm needs to get involved to do all of that testing to be able to tell you what those numbers are. But again, there's so much that people aren't taking advantage of when it comes to retirement plans. Go through real quick the simplified employee pension, the SEP. Lots of times business owners do that because they're like, oh, I can put up to 25% of my salary into that because I'm the only employee of the company, which is true. But if you do the 401k plan and you're over 50, you can put 30,500 deferral out of your paycheck. And then you can do the 25%. And it's up to, I think the limit's 69,000 this year. So that's a whole lot of money that you can put away for yourself, you know, if you don't have other employees. You know, there's the simple plan, which is kind of like a 401k, but for a smaller business, but there's a, you know, the limitation is much lower. I think it's 13.5 this year, that you can put away. And you as a business owner, you're required to do 3%, for anybody that's in there. And that's the max that you can do as the employer contribution, where the 401k plan, depending on the type of plan that you have, you know, you could do, you know, anywhere from 3 to 25%, or you could do, it's called a safe harbor. So there's not testing that's being done. So there are many different types of retirement plans that are there, you know, to take advantage of. Other than health savings account, you know, if you're eligible to put money into a health savings account, and with to be eligible, you have to have a health insurance plan. It is a high deductible plan. You know, the income, the limits for that for 2024 is single can do 4,150, family can do 8,300. If you're over, I have there 50, but it's 55, you can do an additional $1,000 into the HSA. HSA is not use or lose. You get, if you don't use it, it rolls over to the next year, into the next year, into the next year, and so forth. Once you hit 65 Medicare age, then you're not able to contribute to it anymore. But you can still have money in there, and you can continue using it to pay for those medical expenses. So, you know, your co-pays, prescriptions, and things like that you can do that. Eyeglasses, contacts, things that your insurance isn't covering that are qualified medical expenses. We were talking about this with Tim before, you know, before we started this, and lots of times people, they'll max out their 401ks before they do the health savings account. And we were in agreement that it's like, max out your health savings account first, then do the 401k. And the reason being is because your health savings account, I can use that money today to pay for these expenses, where if I'm putting it in the 401k and I need to use it, I need to either take a loan or I have to take a distribution. And if I'm under 59.5, I get hit with a 10% penalty. So where if I'm using the HSA money, I'm not, as long as I'm using it correctly, I'm not getting hit with any penalties, and I'm not paying tax on this money. Employee benefits. You know, take a look at this. There are, I'm gonna say, a ton of employee benefits that are out there that people are taking advantage of. You know, Section 125 plans that are out there, you're able to, your employees are able to have benefits that come out of their paycheck pre-tax. You as the business owner, unless you're a C corporation, you are not allowed to participate in this, but your employees are. The nice thing about it is these expenses come out of their paycheck before Social Security, before Medicare, federal or state tax. So you as the business owner, you're saving that 7.65% that you would be paying in payroll taxes on whatever they have withheld. It's beneficial to your employees because that money's coming out before Social Security, Medicare, before federal, before state. So it's very beneficial to them. And there's a whole range of different stuff that they can do. Talk to Al. Aflac is one that does a lot of these pre-tax type plans, and it's very beneficial to the business owner and to the employee. You know, there's medical savings accounts, there's dependent care that can also come out. And again, I try to talk to people about that. If their company has it, especially if you have kids that are in daycare, after school or before school, you know, a lot of the summer camps do qualify also. you can have taken out up to $5,000 of this pre-tax. So think about it. If you're in, say, the 24% tax bracket and Maryland's 7%, so that's 31%. You just saved 31% plus another 7.65%. So you're at 38% of the $5,000. So, I mean, to me, that's significant money. So it's something really as a business owner to be able to offer this to your employees will really help you from a retention, but then also part of your total package, really helps them out too. Charitable contributions, it's always good to take a look at this, especially, and again, goes back to that budget. When you have budgeted for now through the end of the year that you want to do in charitable donations, and then make sure that the organizations that you are giving to qualify for the charitable donation. Many times, the GoFundMe's and stuff like that doesn't count. GoFundMe is not a qualified charitable organization. It needs to be a 501c3 organization. A lot of people will give to their colleges and universities. You have to be careful with that also because it depends on what they're doing with the funds. NIL has really changed this, where people are making donations to the college and universities to the foundation. Well, that foundation is then turning around and giving that money to the athletes through their NIL, which is making that money not tax deductible for you. So be careful when you're doing any type of funding to your college and university to make sure that you're able to get that deduction. Because many of us, we're doing it to help the college or university, but we also want that charitable donation.
So how do you know? Do they have to disclose?
They have to disclose it to you, yes. Anytime, and then the other thing is, anytime you make a donation of $250 or more, they are supposed to give you a letter thanking you for your donation, and in that letter telling you that you received no goods or services for that money, and the whole $250 or whatever the amount is that you gave is tax deductible for you. Estimated tax payments, again, nobody likes to make estimated tax payments. I will tell you, if you do a lot of the proper tax planning, especially with your business, you should be able to have withholdings come out of your paycheck to pay any taxes that you're going to owe. With a lot of our clients, that's what we do. We sit down at the beginning of the year, say, hey, this is where we think we're going to be. Here's your paycheck. This is how much taxes we're going to come out, and not have to do that. Now, there's going to be times that, your investments do really well that you weren't expecting, or you have a banner year. But again, if you're doing your books and records on a regular basis and reviewing this on a regular basis, you're going to know that month to month. So there's not going to be that big surprise at the end of the year. So again, goes back to doing that planning. Reason why I have this slide in here is more from don't get hit with the penalties. If you pay in 110% of last year's taxes, they're not going to hit you with a penalty for underestimating. If you wait until January 15th and you only make that one estimated payment, they're going to hit you for underestimating, because you have to pay it throughout the year. Okay. Tax credits. There's a bunch of tax credits out there. They're out there for research, development, energy efficiency. In 2023, you could now start doing energy efficient home improvements, and you can get up to a $1,200 tax credit. It used to be, before, you could do energy efficient home improvements and it was a $500 maximum lifetime. They changed that 2023, you can get up to $1,200. And again, it depends on windows and doors and HVAC and stuff like that. Each one of them qualifies for a different amount. But again, it's an annual credit now that you can get up to $1,200. So that's something really to look at. But from the business owner side of things, There are certain types of tax credits that you can get for hiring different types of people, depending on what their background is. You know, if somebody's been incarcerated, if they're disabled and things like that, there's tax credits that are out there that you can get from hiring them also. Again, you know, talked a lot in general terms and stuff like that. Please make sure that you talk to a tax advisor about doing this stuff and make sure that you're setting yourself up for success. The last thing you want to do is go in, think you're doing this, but because you didn't have one piece of paper or something like that, then now all of your tax planning that you did is null and void. So, you know, make sure that you talk with someone who is a tax professional. You know, make sure that they're licensed, make sure that they've, you know, been around for a little while. There are many people that, you know, again, a lot of tax professionals in all of our industries and things like that. So you want to make sure that you have somebody that you feel really comfortable with, that you feel you can go to them at any time and ask questions, because that's, to me, is the important thing. Again, tax law changes, they're happening all the time. You know, with the election coming up, I have a feeling, you know, I don't care who's in office, there's going to be some tax changes that are going to be made. If you look at it from COVID, you know, there was so much money given out and taxes weren't paid on that money. And it's not that people were trying not to pay tax, it's just the way that the money was given. And our deficit keeps growing and growing. So we got to get this money back somehow. I think taxes are going to be raised. When, I don't know. But I just see that's going to happen. It goes into, or it went into effect January 1 of 2024. If your business was in existence before January 1st of 2024, you have until January 1st, 2025 to register with FinCEN. Beneficial ownership is what it's considered, and anybody that is with your business that has ownership in it, and there's some questions on if they're not owner but they're running your business, are they considered that? And there's some rules with it. But the big thing is it's not that big of a deal. A lot of people are making a big deal out of it. There are a ton of scams out there. If you get an email saying, hey, you have to register this, and it's got a QR code for you to scan to get to it, don't click on it. I mean, that is one of the biggest scams right now that is going on with this. And FinCEN is saying, please don't do that. If your business was started after January 1 of 2024, you have 90 days from the time you set it up to file this. So it's a much shorter time. After January 1 of 2025, you're going to have 30 days. So depending on when you set up your entity, depends on that. So, you know, if you're looking at, hey, I'm going to go out and start up a new LLC, just know within 90 days, you have to register with FinCEN. If you have multiple businesses, you can actually get an ID number from FinCEN. So then that way, every time you put a register, you're just dropping in your FinCEN number, ID number. So you're not having to put your full name, address, social security number, and so forth. It's going to save time. I'm going to tell you, most people can go on and do this themselves. I'm seeing CPAs and attorneys that are out there that are charging $5,000 to do this. And they're doing so much of it, they're doing it on scare tactics that, yes, this is a jailable offense if you don't do it. Yes, they can penalize you $10,000 a day for not doing this. But again, if you sit down and do it, it's going to maybe take you 10 or 15 minutes. It's FinCEN.
There's a website for FinCEN.
Yes.
What is FinCEN?
There's a, Gary, the acronym is, we're actually seeing it in the HR world where, you know, we do obviously
So,
payroll,
so
ACH.
here's the website for it. So it's, penson.gov/BOI.
That this beneficial owner information
Correct.
is becoming more and more for us to get underwriting for our clients to be able to do payroll. We have to have beneficial owner information. And it's, again, it's designed, corporate transparency, it's designed there are a lot of bad actors out there. And just to kind
Look,
of,
the big thing is money laundering.
right,
And that's what they're trying to do. They're trying to find out, who the owners of the company are and stuff like that. So if they're cash flowing through, what's the requirement now? Because it's gone down for cash now.
it's still 10.
Is it? Okay, I thought now it was like 4,900. There had to be. So as a business, if I were to take $4,999 or more, I now have a form that I'm supposed to fill out to send in.
There's an internal form that the banks fill out.
Okay.
For certain amounts. It depends on the bank. Too.
Right.
Sometimes it can start $2,500.
Yeah. Yeah. So again, what they're trying to do is they're trying to crack down on the money laundering and stuff like that. So that's why they started this. And again, they did it, I believe it was passed in 2022. And it's a Corporate Transparency Act is what this all falls under. There are a lot of people that are up in arms about this because why do I have to give Big Brother all my information and stuff like that? And it's like, they have it anyway. I mean, that's a reality. So if you are if you are a sole proprietor and you have not registered with the Secretary of State, so difference being, if you set up an LLC and you're being treated for tax purposes as a sole proprietor, you have to file this. If you are straight, I'm selling stained glass out of my garage and I didn't register with the state as a company. Now I can still have my sales tax ID number, but I didn't register with the state. I'm not required to do this. There are some other stuff that other requirements for being exempt. I mean, nonprofits and things like that, banks, education institutions and so forth, that you don't have to. But again, I think that they've done a halfway decent job of going in here and having, if you have any questions and things like that, to be able to, the frequently asked questions is what I was looking for. So they have, I mean, you name it, they have it here. They talk about who has to report, who is exempt and everything else. So it really it takes no time to fill this out.
So what's the deadline on this?
So if your business was in existence before January 1 of 2024, you have until January 1 of 2025.
The one-time thing, right?
Glad you told me.
Yeah, but
It's supposed to be a one-time
Okay.
thing.
but
now-
that,
But if you have change in ownership, so
Okay.
you have your business and then whatever, in August, and you register in August, you bring in another owner or you sell part of your business. You have 30 days from that day to update this.
Okay.
I feel like it would be great if the chamber like to do that for business owners, like let them know that. this is-
Absolutely, we
I
can-
had no idea.
and that's.
So, and part of the issue is that literally they were supposed to have this website up and going on January 2nd.
Oh.
You were not allowed to do anything ahead of time.
Okay.
Because a lot of us were trying to find out, okay, here, let's take a look to see what it is. So then that way, especially going into tax season, hey, let's get the client to fill all of this out and so forth. And literally it was, and it didn't get up until I think the 9th. So they were delayed in doing this. So this is something that's really, really new.
People out there don't have access to Gary Heldt. How would they then have been getting this information?
That's,
That's why I didn't hear it.
that's-
Or the government?
yeah,
needs
I mean, but
to
that's, I'm gonna say that's why they need to have a Gary Heldt or somebody, that's helping them with this. I mean, I'm telling, my clients, that this is something we can do for them. We're gonna have to charge them to do it,
Yeah.
you know, but it's gonna be minimal. It's not gonna be, you know, $5,000 or anything like that. I mean, I think that most people that are going to do it with their clients are gonna charge a couple $100
So two
to
things,
do it.
I don't mean to interrupt. Number one, the room, the participants could not hear the URL, so I have shared that. They also can't hear our questions as well as us talking.
Sorry.
And so, and I also want to say, you know, Cheryl, I think you are not alone, in that
I'm
nobody
Yeah.
nobody knew about this because it wasn't, again, to Gary's point, the site didn't launch until after January 1st and whatnot. But I think this is also a lot like Maryland Saves and other things that have come out, where it's let's get it out and then
Promote it later.
and promote it later, or maybe, you know, not focus so
Well,
much on the promotion of it.
But I think part of it's been delays. I mean, because again, they
Maryland
passed
Savings,
this, you know, a couple of years ago and said, okay, we're gonna do it. And then, you know, it's a couple of years later, and then again, unless you're like paying attention to the scam emails that you're getting, then you're not gonna know. I mean, it's the same thing, the 1099-Ks. So if you do anything through Venmo, PayPal, or any of those, this year, so 2023, they were supposed to kick out the 1099-Ks. Well, now they've said, okay, we're gonna push that back another year. So this has been kicked down the road. I think this is the 4th year that has been kicked down the road, because they're saying, okay, how are we gonna handle this when, you know, I'm sending my kids money through Venmo or some other cash app? Well, my kids shouldn't have to report that on their tax return. So what IRS is saying is, yes, you're still going to get that 1099-K. You need to report it on there, but there's a way then to go on another line and say that this was not income and subtract it back off. But then they're also talking about, they want to raise that limit to be, they're talking about 25,000 to issue the 1099-K. So again, that's something that has changed. But again, this was passed back in, I think it was 2018, it was passed that they were doing, and it keeps getting kicked down the road. You know, so there are some things like that that are going to keep being kicked down the road. I do think that this will be something during the summer that will come out and do another, big or lunch and learn or something to talk a little bit more about it. Because again, I think it's something that needs to be done. But I think I would like to see some more things be flushed out before everybody starts filing. But again, be very careful, because there are a ton of scams out there on this.
There's something from the state of Maryland. My company told me she can do it, or I can do it, or I have to go online somewhere and pay $300.
So if you have a business registered in the state of Maryland,
Right.
So you have what's called a personal property return that you have to file every year to stay in good standing with the state of Maryland. So any assets that you purchase in your business, and again, it depends on the business, then you would have to report that on that personal property return, and then you'll receive from, Anne Arundel County or wherever your business is housed, you'll receive your property, your personal property tax bill. But there is a $300 filing fee. Now, last year, if you had a retirement plan that was in existence, or if you signed up for Maryland Saves, you could get an exemption from having to pay that fee if you filed by, I want to say it was like December 15th. They're talking about renewing that again, but I haven't seen anything in writing on that yet. But yes, and so the personal property return is due April 15th. You can get an extension until June 15th.
You can get the forms online.
Correct. You can actually fill a personal property return out online. I'm going to tell you, most CPAs are going to give you the paper return for you to sign and mail in with the check. And the reason why, we do that, because if we had to go in online and fill that out for each one of our individual clients, that would take forever. And we would charge you a heck of a lot more than $300 to do it, because it is, I mean, it would be time consuming to do it online.
Okay.
So you think it's best that we just wait till later in the year to
I would.
file this?
I would. And Cheryl, and the reason why I say that is because I think there's going to be a little bit more fallout from this. And again, you got until January 1 of 2025. Now, if I opened up a new business, last week,
Right,
yes, I'm
yeah,
doing
yeah,
it within
right.
the 90 days. But I also look at it that if you're going to have your CPA or somebody else do it, until they're not so busy.
Right, yeah.
Yeah, so that's why I'm thinking, for us and our clients, a lot of it we're going to do this summer.